Kind of like yesterday, upside down. This time stocks lower, yields higher. From New York City this morning, good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue. Bear market bounce or the real deal?
The bear market rally.
That is the risk here.
It's good that markets also can turn upwards.
We just did that back in June.
I think any rally is going to be short-lived.
We saw a near-term peak in yields. We saw a near-term peak in the dollar that led to a big rally in stocks.
A two-day rally is pretty normal when you get that peak type of fear from the VIX.
We want to see capitulation.
That feel of capitulation.
The sign of capitulation.
Getting those earnings expectations down is something that we really need to see.
Investors want to hear management speak.
See some companies rip off the earnings Band-Aid
and really kind of throw in more of a towel.
We think about how long this rally in markets could continue from a stock basis.
There's still some major macro headwinds.
Let's get the conversation started. Joining us now is Morgan Stanley's Sri Sankaran Invesco's Rob Waldner. Rob, first to you. George Goncalves over at MUFG. Fed pivot dreams strike again. Are those dreams going to be realized anytime soon?
Well, they're certainly not being realized right now, Jonathan. I think, we are looking for a Fed pivot to be the durable bottom for the market and really to give us some certainty about, risky assets going forward. We certainly don't see any signs that the Fed has pivoted yet. I think we've had a few sort of little hints that pivots may be in offer. The RBA was a little bit dovish. What happened with Bank of England last week, that probably got people a little bit excited that maybe the Fed might pivot. But they've been very clear that until they see inflation coming down, they're not going to pivot. So I think don't fight the Fed.
Sri, I feel like we've had this conversation 5 different times in the last 5 months. What's your take on it now?
Yeah, I agree with Rob there. I think what really is going to be the key debate is what forces that pivot. I mean, and to some extent, I think the definition of the pivot is also something that we're struggling with. Is it going to be the economic data, which gives the Fed the bandwidth to start thinking about decelerating, then pausing, then pivoting? That to me is like a more positive outcome. If it is a market kind of an accident or a market mishap, more disorderly price action that forces a pivot, that is probably going to be much sharper in terms of how quickly they move. But, I mean, these are known unknowns, to be honest.
Well, Sri, I had this conversation with Mike McKee earlier. What do you think we bump into first? Do you think you bump into a pivot that's driven by financial stability concerns before they even achieve that lower inflation outlook?
Yeah, that's a tricky one. To be honest, the hope is that you will still see the data start to decelerate. I mean, obviously, the JOLTS and the ISM data to some extent give you that signal, but clearly the negative surprise on the upcoming jobs number and the CPI prints have to be like significantly weaker to kind of remove or change that 75 basis points to 50 basis points in November. We don't think that happens, but it feels like, the hope is that it's the slowing down of the data that forces that pivot rather than a market mishap.
Rob, your thoughts on that particular question?
Yeah, see, so the problem I have with the way this narrative is set up by the Fed is that they're looking for inflation to come significantly down. And we know that inflation is lagging. A lot of the inflation that we have now is a result of stimulus from 18 months ago. So I just don't see, I think that the chances of the event being more of an accident and less of a slowing of data, I think is increasing as they stick to their guns on this, set policy based on lagging indicators methodology.
I think it's driving us all nuts. We get 2 days of gains on the S&P 500, biggest 2-day pop going back to spring of 2020, and it's pivot on, and then you get a morning of losses, it's pivot off. It's ridiculous. Philip Jefferson over at the Fed, the governor, incoming governor, new governor, had this to say: restoring price stability may take some time and will likely entail a period of below-trend growth. He went on to say, my colleagues and I are resolute that we will bring inflation back down to 2%. We are committed to taking the further steps necessary. Kelly Lyons joins us for more. Hi, Kelly.
Hey, John. So basically saying don't get too excited with this whole pivot idea, which the market frankly has in the last 2 days. The best 2-day rally for the S&P 500 going back to April of 2020, as we've gotten a series of economic data points that maybe lended the market to believe that the pivot could be coming. On the one hand, you had that weaker ISM manufacturing data, the kind of softness that maybe would cause some pause on the part of policymakers. And then you had jolts yesterday, a million drop in available jobs here in the U.S., those job openings, something that maybe the Federal Reserve would like to see. And then, of course, you had ADP data topping estimates a little bit this morning. We can debate how much of a signal that really is ahead of Friday's jobs report, but that payrolls report and next week's inflation data is going to be critically important, especially as we have seen this revival of the narrative. Although I would note it is changing a bit today, where you're seeing futures heading back down by about 1% on both S&P E-minis and NASDAQ 100 futures, and yields once again are heading upward. And of course, the Fed has given really no indication to believe in a pivot at this point. Not just Philip Jefferson, but a chorus of speakers pretty much every time we hear from them saying the job is not done. We are going to keep going until the fight against inflation is won. And of course, the market seems to believe that they will ultimately go farther, with 75 basis points priced in for November, 50 in December, another 25 early in 2023. But they don't think they will stay at that terminal rate for as long. A cut in 2023 back on the table for this market, John.
Kelly Lyons, thank you. Certainly the terminal rate has been repriced in a big way over the last week or so. I went through the transcript of an interview we did 2 Tuesdays ago with Mike Wilson from Morgan Stanley. Almost eerie what he said and what's played out subsequently. Take a listen to this.
Whatever rates do in the short term can dictate equity prices in the short term as well. And so if we get a rally in the back end, which looks like it should happen from here, then stocks could get a little lift here into earnings season. It's kind of the opposite of the June quarter. We may rally into the earnings season, and then the news is actually worse than feared because companies finally start talking about the risk from currency, the risk next year from a recession, and all those things kind of get priced quickly.
Sri Sankaran, can you share the Mike Wilson crystal ball with us? What are you looking at right now going into earnings season? What are you expecting?
I think the back half of the clip that you played, that is the crux of it, right? So in terms of how much of a downside surprise that we get to earnings guidance, and from the perspective of the credit market, it feels like the next leg of it is going to be about how persistent is that earnings slowdown. To me, it's not really about, if it's a technical recession or a growth recession versus a full-blown recession, earnings recession versus an economic recession. I think these are obviously important elements of it in terms of how it drives the rates volatility. But when we think about the bottom-up credit fundamentals and what drives it, Mike's earnings forecast and the downside that he has versus consensus, that's one. And two, how long that downside persists along with inflation or along with rates staying at these current levels. I think those are the dynamics that we're closely watching from the credit lens.
So, Sri, you're saying this is not a binary event when it comes to recession?
Yeah, I mean, we think it's more around, particularly from the lens of credit markets and the lower quality credit markets. If it is a short-lived recession, a jolt, that works in the sense that a lot of the companies should be able to survive that. And if we get into a full-blown easing cycle, that reduces a lot of the pressures. But if we are looking at this setup of slower earnings or low earnings, sub-trend growth, and kind of still elevated rates for a persistent period of time, that's when that feedback loop into fundamentals start to work in a more meaningful manner.
Rob, we'll talk about the credit market specifically in a moment with you, but I caught up with Mike Gapin of Bank of America 40 minutes or so ago. What he had to say about next year was fascinating to me. He basically said recession starts at the start of 23, goes through 3 quarters, but this Fed doesn't start cutting until the end of the year. Now, Rob, I think that's really, really important when it comes to risk, because we're talking about a Fed pivot as if in and of itself it is just bullish per se. But what if we get a Fed pause and no cuts to the end of the year, and a Fed that tolerates 3 quarters of negative growth?
Well, that would be obviously very negative for all risky assets, because the headline, your top line growth would continue to come down, your top line in the economy, and you'd keep those financing rates really high. I don't think the bond market would sit around in that environment, though, and just take the Fed's guidance. I think you'll see the curve really start to invert. I mean, we would actually expect the curve to continue to invert going forward here and see a peak in bond yields, this quarter, even though Fed funds are not going to peak until 2023, because the bond market will see through that and understand that that concept of sticking at a very high rate, even when the economy is in recession, just because inflation is still above your target, won't really make sense to the market.
Bit of breaking news on the crude market, that's for sure. OPEC Plus, the panel recommending a 2 million barrel a day cut to output, according to a delegate. OPEC Plus, the panel recommending a 2 million barrel a day cut to output limit. We're going to hear more about that a little bit later. In response to that, crude elevated a little bit, up 0.6% on WTI, $87 a barrel, up 0.8% on Brent, 92.60. We'll catch up with the team a little bit later. Down in D.C., Bloomberg's Anne-Marie has got some things to say about this, and we'll talk to her in about 40 minutes' time. Wanted to talk to you, Sri, about the price of the story in credit. The price of the story. We've talked about the story. Let's talk about the price. When I look at spreads, I see one thing. When you look at yields, I see another. Can you tell me the difference between the two?
Yeah, John, I mean, that is the critical debate that we're having within the credit markets, right? So you look at the spread measures, I mean, regardless of whether it's investment grade or high yield, I mean, these are elevated levels. This is kind of signaling some degree of stresses in the credit market, but nothing that would kind of make the Fed blink or in some ways signal that the credit market is dysfunctional. I think, but when you start looking at the yields, and this is where the investors are also kind of trying to figure out what is the right valuation measure to think about. I mean, all-in yields and investment grade, they're above the COVID highs. On high yield, we breached this only through COVID and also in the GFC and very briefly in 2016. So all-in yields are looking attractive, and prices are also low, which kind of limits some of the downside that you get in a default cycle. But for now, I mean, it feels like we still have to solve for further widening in spreads. And the more important element of the high yield or the leverage credit market is a more functioning primary market is what we need to see. We need to see the clearing levels for risk with deals getting done at those levels. And that was what would give me confidence that we have kind of topped out in terms of spreads. But yeah, yields are looking attractive now, but spreads are not.
Well, Rob, some of these deals aren't getting done. What do you make of market access over the last couple of weeks?
Well, I think this is the big risk going forward in credit always is the ability to refinance. But, we've really been sort of back to the question about all-in yields. We think that the high quality credit sector is really offering some real opportunities here where you don't have that immediate default risk that you might get in lower quality credit. And actually, if the Fed pivots, you probably do pretty well. And if you go into a recession, you'll like the duration that you have higher quality credit. So, we would stay up in credit quality.
I can't interest you in some CCC unsecured debt, Rob.
Not today. Thank you very much.
Not today. I didn't think so. Rob Waldner, Sri Sankaran, going to keep you both out of trouble. To the both of you, thank you. This is a big story for us, for the likes of Twitter as well, not just on the equity side, but on the debt side too. We'll get to that in just a moment. Right now, the breaking news 5 minutes ago, OPEC Plus, the panel recommending a 2 million barrel a day cut to output limit. Hearing that from a delegate, we'll wait for confirmation from Vienna a little bit later this morning. Futures lower by more than 1%. Coming up, Elon Musk reviving his $44 billion Twitter bid.
Clearly, if you're in the leveraged finance part of major New York investment banks, you're a little nervous after the two most recent incidents, Citrix and Brightspeed, and you're looking at Twitter, you're going, oh my God, can it get any worse than this?
That conversation with Dan Ives of Wedbush up next.
Elon now coming back to the Twitter deal. Now that you're seeing the market recovering, now that you're hearing from other Federal Reserves around the world that they're starting to think about loosening how far they're going to go on interest rates, you're starting to see equity multiples come back. And that also could have been a consideration. As market prices are improving, that also made the deal financially more attractive at where he had agreed to it previously. And there's still a very long path from here until the deal closing, but it certainly seems as likely as it's ever been now.
That's the constructive view. Elon Musk reviving his $44 billion bid for Twitter, dropping one line on the social media platform and tweeting the following. Buying Twitter is an accelerant to creating X, the everything app. This coming as Wall Street struggles to offload buyout debt, adding pressure on lenders. Let's get to the Bloomberg team. Ed Ludlow, Shanali Basak. Ed, what happened?
Yeah, we're exactly back to where we started in April. Same offer price, same terms and conditions. The key line in the letter that Musk sent to Twitter was that it needs to be a stay on all legal proceedings. They have to drop their case, essentially. A source told Bloomberg that Elon Musk's legal team essentially looked at going to trial in October, starting on the 17th, didn't fancy their chances. one of the conditions going forward could be that Kathleen St. Jude McCormick, who is due to preside over that case, actually kind of acts as a moderator or adjudicator to get this deal closed. Already questions about how quickly it could close. If you go back to the April 25th agreement, section 2.2 around closing, many of those conditions have been met. Twitter shareholders voted in favor of this deal already last month. The regulatory waiting periods have already elapsed. So where do we move? You mentioned X. All we've heard from Musk is that he's thinking about an app that could be much more than just Twitter as we currently know it, perhaps something like a WeChat, this big picture vision, but we have so much further to go. In its statement last night, Twitter said, we want to close the deal at $54.20 a share. That is all they said. They didn't give us any indication on how they plan to react. We're showing shares of Tesla lower for a second straight, lower 2% in pre-market, but pairing gains during yesterday's session. Why will Musk sell more Tesla stock to fund this deal? What is the element of key man risk here if he's distracted?
Shanali, take me inside Morgan Stanley and how you think they reacted as the story was developing just yesterday.
On one hand, you're happy the deal is going through and that you will get the fees for that deal. But on the other hand, you have Morgan Stanley and a range of banks, John, that could be on the hook for potentially hundreds of millions of dollars in markdowns, given where high yield debt is trading today and what they promised all the way back in April. Now, the interest rate promise on the riskiest part of this financing was under 12%. And as we know, CCC is trading above 15%. So that is a material difference. And remember, global banks, U.S. banks alone have taken $1.3 billion of hits in the second quarter alone. If you look globally, that's more than $2 billion. And spreads have really widened out since then. So the third quarter is already not looking good. Scroll forward, because if you look at Twitter, you look at Citrix, you look at Nielsen, you look at Tenneco, and you look at all the deals out there, a source of mine says that the market can be pretty icy here for as long as the next 12 months. Now, I've been testing that idea around the market, and there's a lot of debate around that idea, but really these large LBOs and the hangover they're creating in the debt markets can be quite the chill here as we look into next year.
Shanali, unfair of me to ask this of you because I couldn't answer this question this morning. Can the banks get out of this?
They can try to renegotiate this, but I don't know how much success they've had negotiating with Elon Musk before.
Makes me wonder, Ed Ludlow, whether this deal can close or not. It's revived the story of yesterday. Can this close?
Yeah, look, I've spoken to a lot of Twitter insiders, employees in the last 24 hours, and frankly, they do not believe that this is an attempt by Musk to close it. They think it's a stalling tactic because he wasn't ready to go to trial. Ultimately, though, the stock reaction that Twitter saw is the market saying, OK, we think this is going to happen. It was the biggest jump since April 4th when he first announced his stake. We're almost at the $54.20 price. We think it will close.
And with Shanali, the debt side of this is the much more interesting piece of it. Shanali Basak, Ed Ludlow, to the both of you, thank you. Dan Ives of Wedbush has been on a journey following this, raising his Twitter price target to, guess what, $54.20, and saying the soap opera now comes to an end with Musk owning Twitter at the original price tag. For Musk, the irony is the easy part of this deal was buying Twitter. The hard part will be fixing it with monetization and subscriber engagement. We expect the deal to close without any major issues over the next few weeks. Dan, can I pick up on the last piece of that? Why do you think this closes without major issues, given the debt side of the story that Shanali just went through?
Yeah, I mean, clearly there's some debt issues that the bank's going to need to deal with. But in terms of Twitter's board, we believe over the next 24 hours that they take away their lawsuits. And I believe this deal could close as early as next week. Because for Twitter, this was a situation where Musk saw writing on the wall. He knew he was not going to win in Delaware. And I think it's sort of now this old sort of Western standoff now ultimately ends with Musk owning Twitter probably by next week.
If it happens by next week, we start talking about X. Can you tell me what X actually is?
Look, I think that's part of the problem. The easy part, ironically, for Musk was buying this. The hard part's going to be fixing it. The monetization is going to be an ever-like uphill battle. And of course, there could be some subscriber that they could add from a monetization. They could look for more, content partners. But this is going to be just a massive transformation in the next 18, 24 months. And it just comes down our view from the beginning. I mean, this was a ridiculous price that he's paying, but ultimately got locked into it. And with Tesla, I mean, he's essentially selling caviar to buy a $2 slice of pizza in Twitter.
I'll get to the Tesla side of it in just a moment. Dan, who's running this company?
I mean, I think, look, in the near term, it could be Musk, but ultimately he's going to have to farm this out to some social media experience execs because, this is not his sort of swim lane in terms of knowing how to turn around Twitter. But it's part of the problem here. Spread too thin, and that will be a worry, especially for Tesla investors.
I won't try and extend the analogy and talk about caviar on pizza, but can you tell me about the relationship between Tesla and Twitter from here, how you expect that to develop in any way, shape or form?
The biggest problem, Ed hit on it, is does he have to sell more stock? I mean, we believe it could be up to $3 billion that he sells, and that continues to be a bit of an overhang. But I think a contained overhang here. But the broader worry is just key man risk. I mean, does he start to juggle too many balls at the same time? Twitter's a new kid on the block. Tesla needs Musk more than any other time, given what we're seeing in EV supply chain. This is coming off a delivery miss. So look, I think for Tesla investors, they're just worried. This has been a nightmare. Look forward to being in the rearview mirror, but clearly there's some work to be done ahead.
It's not in the rearview mirror yet. Dan, can we finish there? Can we talk about risk factors to your view? You're not the only one who's struggled to understand through the summer as to whether this would close or not. What's the number one risk that you think would prevent this from closing?
The number one risk would be the Twitter board ultimately not being comfortable with the financing, given some of the issue that you're talking about, and basically not pulling their lawsuit. Then this really starts to get complex if this actually starts to go into Delaware and they do not pull their lawsuits. And I think that probably is the most complicating factor because, of course, Musk and Parag and the Twitter board are not going to be doing a candlelight dinner. There's no trust factor. They're snake bitten. That's going to be the issue.
I imagine there won't be a candlelit dinner with the banks anytime soon either, based on some of this. Dan, thank you, sir. Dan Ives of Wedbush there. Twitter a little bit lighter, softer, lower this morning. Got to pick up on the crude story too. The OPEC Plus panel recommending a 2 million barrel a day cut to the output limit, according to a delegate. Crude off the back of that is positive on WTI and Brent by about 1 full percentage point. Coming up, the morning calls and later, futures pulling back after a massive two-day rally. Goldman's Sharon Bell says the bear market has more downside ahead. That's coming up next. 5 minutes away from the opening bell. It's yesterday upside down. Stocks down, yields up. Stocks down by about 1.2% on the S&P. That's the price action. Here are the morning calls. We begin first up with Atlantic Equities downgrading Morgan Stanley to neutral, $85 price target, highlighting declines in its investment banking activity. Morgan Stanley upgrading Ford to overweight, seeing an attractive valuation and potential upside stemming from the Inflation Reduction Act. Deutsche Bank upgrading Church & Dwight to a buy, saying the stock historically performs well during times of consumer distress. That stock is positive by about 0.4%. Up next, bear market bounce on a real deal. Goldman's Sharon Bell sounded the alarm, seeing further downside ahead for both US and European stocks. Your opening bell up next. "24 seconds away from the opening bell this morning. Good morning to you. On the S&P 500, futures negative, down a little more than 1%, following the biggest two-day pop on the S&P, going all the way back to spring 2020. On the Nasdaq, at more than 5% in just 2 sessions. Right now, futures negative 1.36%. There's your opening bell. Switch at the board and get to the bond market. Yields much lower than they were last week, but higher than they were yesterday. Up 8 basis points on the day now to 371 on a 10-year. In the FX market, euro dollar negative 1%. Yields up, dollar stronger. Euro dollar 98.77. Looking at cable, 112.91. What a range on the pound today. The high 114.95. The low is right now. We're down 1.6%. Want to finish on crude, up 0.9% there, $87.30. OPEC Plus coming together, and it looks like they're going to deliver a 2 million barrel a day output cut. This is going to be very controversial in Washington. We're going to catch up with the team on the ground in Vienna through the day. We'll catch up with Anne-Marie over in DC in just a moment. Let's get you some price action at the opening bell. Let's get to Abby for a little bit more. Hey, Abby.
Hey, John. Well, cooling off, that's the name of the game after the best two-day rally for the S&P 500 going back to April. Today, the big winners of yesterday and Monday, they're down. Apple had gained $120 billion in market cap over the last 2 days. Today, down 1.3%. This, of course, as you were just outlining, yields are higher. That, of course, is pressuring valuation. Same deal for NVIDIA. NVIDIA had added 8.5% in 2 days. The stocks also up that amount. out. Interestingly, Morgan Stanley is saying that chips are likely to cool off. We're certainly seeing that today for NVIDIA. Carnival down 4.8% over the two-day rally of Monday and Tuesday, up 10.4%. So again, investors selling what they had been buying. And speaking of buying, John, well, Twitter, it is down 3%. The deal's back on, and that means that yesterday's 20% pop, well, a little bit of consolidation there. But to Ed Ludlow's point earlier on, the fact that it's close to that $54.20 price suggests market investors think the deal will get done.
Stock is all over the place. We're down about 2 or 3 percentage points in early trading. Let's get back to Ed for a little bit more. Morning, Ed.
Yeah, good morning, John. I think the sell side at least is sanguine about this. They look at the equity market reaction we saw yesterday, the big jump in Twitter shares. We're giving some of it back at the open here, but they say despite the unknowns and despite the uncertainty, there are a few maneuvers left for Musk to actually use, and so we feel like we're moving towards the close of this transaction. What is still unknown is what Twitter does. They actually need to decide how they handle the legal proceedings, which are still active in the Chancery Court in Delaware. One of the requests that Musk made in his letter to Twitter was we can move forward at the original terms agreed in April, $54.20 a share, if there is a stay of legal proceedings. There was no indication from the communications Twitter gave out last night that that is the case. We look forward to it. Then there's what happens next in terms of the pace of closing the transaction. Many of the conditions set out in April, which we're sticking to if Musk is to be believed in terms of the original terms of that deal, have been satisfied. And what does Twitter look like in the future? Let's not go there yet. I feel we have a long way to go. Tesla also under pressure, of course, this idea that he will have to sell some Tesla stock to finance the equity financing portion of this, and the idea that he's already CEO of 2 companies. What if he becomes CEO of Twitter, which would be a third? He's a pretty busy guy.
A pretty busy guy already. Ed, thank you. It is hard to keep up with this. One thing we can all agree on, because by definition it is true, is that a lot has changed between April, when we were talking about this deal getting done, and now in the equity market and in the debt market too, both in the market and in the economy as well. Amazon, the latest tech giant to try and control costs following Meta in hitting the pause button on hiring. Taylor Riggs has more. Hey, Taylor.
Yeah, John, and similar to what we were talking about yesterday, right? Not layoffs, but a hiring freeze and a maybe reevaluation of some of the recruitment practices that they have until the end of the year. So Amazon, of course, they announcing that it would be more the corporate positions in the retail business. Nothing about some of the warehouse workers as well. But nonetheless, this is an interesting story, given, of course, what you mentioned about Meta as well. When you think about the number of employees, John, I think what's really interesting is Walmart's been, of course, the big private employer. I was taking a look at a number of employees for Amazon at the end of last year, 1.6 million, and that was also sort of a quarterly number. But then the second quarter, we've dropped to 1.5 million employees when you think about Amazon. So maybe looking again at a little bit of a smaller company next year than we have this year. That echoes some similar comments that we've heard from Meta and Facebook.
Taylor, do you think this speaks to the data we've seen, that claims are below 200K, that job openings came down 1 million, that these companies aren't talking about layoffs, they're talking about not hiring anymore? We're talking about freezing.
I hear anecdotally and in some of the data, John, that you know, that laying off is so hard because it's hard to get workers in the door, that hiring freezing, of course, is a much easier step to take. There's also some interesting data, as you know, in that ADP report about the wage gains for workers who are not changing jobs versus the doubling of that number for workers that are changing jobs. So some interesting anecdotes as well.
Speaks to the quits rate. Taylor, thank you. We've used this line a few times. It's not mine. I've borrowed it from someone else. But you can't fire what you couldn't hire. And maybe that's what we're seeing in job openings. Or they've just been filled. And we'll find out on Friday if payrolls are exploding. The moves we've seen in the last couple of days, big. A little bit of a move lower this morning. We're down about 8 or 0.9%. Some of Wall Street's biggest banks were not buying the two-day bounce in equities. Kaylee Lyons has more. Hey, Kaylee.
Hey, John. Yeah, a big bounce it was. The best 2 days for the S&P 500 going all the way back to April 2020. But if anyone out there wanted to believe that the rally was going to continue, the bears on Wall Street are saying, hold your horses. We don't think so. The latest out is Max Kettner over at HSBC, who has cut his year-end price target for the S&P 500 to 3,500, joining the likes of Goldman Sachs, Bank of America, Morgan Stanley, all of which see more downside from here. What they're warning about is that prices still don't fully reflect the risks of higher interest rates on earnings and on valuations. And that is why we have seen a steady decline in the outlook for stocks. Back in April, the average year-end target among Wall Street strategists was around 48.46. By mid-September, that was down about 500 points to 43.46. And now with the recent downgrades we have seen, not just from HSBC, but even Jonathan Golub over at Credit Suisse earlier this week, that's likely to go even further south come the October survey. And speaking of going south, a lot of these bears, as I said, are expecting corporate earnings to go in that direction and that the downward revisions are going to come in a much bigger way. But they have not yet. So far, no earnings recession is in the forecast. Yes, EPS growth is expected to slow to about 2.9% in the third quarter. Results we're going to get very shortly. But then it's expected to pick back up and in the fourth quarter and into next year. Maybe still a little bit too optimistic if you listen to all those shops I was just rattling off, John.
Katie, thank you. That is a wonderful summary. We can continue that conversation. A simple question: what are the preconditions needed to add to equity exposure? Sharon Bow laying out what needs to be seen to call a bottom in equities and saying the following: we need genuinely low valuations, an end to the deterioration in growth, a peak in inflation, and rates and light positioning. We would argue we are not decisively there for any of these in the US or Europe. Sharon from Goldman Sachs, I'm pleased to say, joins us right now. Sharon Bow, wonderful. Let's start there. The preconditions to add to equity exposure. You went through a list of things there. Are we closer to achieving that in the US or Europe?
That's a good question. I think on the valuation front, Europe is decisively cheap versus its history. Not necessarily versus other asset classes like bonds, but just in absolute terms, the PE is quite cheap. So yes, on that front. Maybe on positioning as well, people are quite under-positioned in European equities because of the risk, because of the war, because of the volatility recently. So on those counts, yes, but probably not on the count of an end to the deterioration in growth, which I would argue is the key one. And in the US, still not all that cheap versus history. Valuation on the S&P is about 16 times forward earnings, which is sort of long-term average, not particularly inexpensive. Positioning, yes, it's probably relatively low versus history, but not at rock bottom levels. And the deterioration in growth, well, you've just been discussing the employment figures, they are coming down. So I think that, again, on both counts, not particularly close at the moment.
Sharon, just going through your calls, underweight the consumer, overweight the banks, energy and basic resources. Can I just pick out two of those? The underweight the consumer and the overweight the banks. Can you reconcile those two things?
Yeah, I do think this cycle is going to be very different from the last 4 or 5 that we've seen. So if you think about it, particularly in Europe, and my main focus is on European stocks, banks have generally performed incredibly badly in the last 10, 15 years, ever since the financial crisis. But ever since the financial crisis, we've had low inflation, we've had low rates, we've had disinflation. Now we have some more inflation, now we have higher rates. And that's great for the net interest margins for the bank sector. Of course, they do get hit by maybe non-performing loans. As you see economies weaken, they get hit by a lack of loan growth, as you see the housing markets perhaps turn with higher interest rates. But I think overall they'll gain from higher net interest margins, and that will be unusual for them. They haven't seen that type of improvement in the last 15 years. Also, household balance sheets are reasonably good. So yes, you're seeing a tightening in terms of a hit to the cost of living. You're seeing higher inflation, you're seeing low real income growth. But households in aggregate still have net savings, and they can use some of those to pay off higher loans. And as long as they have jobs, unless there's a very sharp deterioration in the labour market, I'd expect them to continue to pay loans and mortgages. So I think banks will be less cyclical this time, is what I'm saying, and actually have got something to gain from higher interest rates.
Everything you just said, though, about the banks becoming less cyclical and perhaps even defensive off the back of rate hikes, Sharon, do you think that's good enough to attract capital, given how concerned some people might be about financial stress across the continent?
Yeah, look, I think that's an absolutely valid point. And I should say the other thing about banks is they are extremely inexpensive. They're trading on valuations which are mid-single-digit PEs. This is below the levels they were at in the sovereign crisis, for example, when people were genuinely worried about the sort of integrity and sticking together cohesion of Europe. So I don't think we're at such a risky point for banks now, and I think they shouldn't be on such low levels of valuation. That is not to say there are no risks at all for banks, and sort of financial market volatility is, there's some benefits to that for the banks, but generally speaking, that adds to the risk premium, and that's not helpful for banks' valuation, and that's why they already trade on very low multiples. But the dividend you get from banks is pretty good, 5 or 6%, and the payout ratio is not particularly high. So they're being pretty conservative.
How have they traded, Sharon, in the last few months? Have they traded tightly with peripheral spreads, or have we broken that correlation finally?
It's not completely broken. I think it's not as tight, though, as it was during the subprime crisis or other periods where you've seen peripheral spreads widen. And I think the reason for that is a couple of reasons. One is they're not actually big holders of peripheral debt anymore. Even the Italian banks aren't that large holders of peripheral debt. And why is that? It's because who owns the peripheral debt now is largely the central bank, having done years of quantitative easing. Also, the banks have been keen to reduce their exposures to more risky assets like peripheral debt. They've improved their capital levels. They've reduced those type of risk assets. So I think overall they've been slightly less tied to sovereign spreads. But that doesn't mean, of course, they won't be a little bit tied to that. And they certainly are a domestic European risk asset. They also tend to be hit when domestic currencies come down. So the euro and sterling coming down is unhelpful for the banks. Why is that? They don't really import in a lot of goods, but they're not exporters. They don't generally make money overseas. So it's the companies and sectors that make that money overseas that do better when European currencies are falling. So on a relative basis, they've lost out from that. But generally speaking, year to date, banks have not been underperformers. We've had the market come down. We've got severe risks of recession. We've got consumer confidence at rock bottom levels for the last 40 or 50 years. And yet banks have slightly outperformed in Europe, which I think is very telling. That they are acting differently this cycle.
It's a tough moment in Europe, that's for sure. We've talked about the banks. Let's finish on energy. Sharon, can you tell me, just from a structural standpoint and what you see playing out in Europe at the moment, access to energy supplies, etc., whether you think these issues go beyond just this winter, and if that's a reason to maintain an energy overweight, even in a difficult part of the economy cycle?
Yeah, so again, I mean, energy is typically a cyclical sector, isn't it? But it's demand and supply driven. So absolutely, I can see demand coming down. We have a recession across Europe through 2023, and that's going to hit demand. It's going to hit demand for energy. It's going to hit demand for many different assets. But there's also a supply side of this equation too. With OPEC potentially withdrawing some supply, with supply anyway incredibly tight for lots of commodities, including energy, I think that will keep prices relatively high and makes that sector quite attractive. In addition, just like banks, it trades on an incredibly low valuation, mid-single-digit PE multiples, a dividend yield which is very well supported by earnings and cash flows, and is around about 6%. So good dividend yield, low valuation, a constraint in supply, all of those things I think adds up to good performance for the energy sector. And then on your other part of your question on 2023 and sort of the energy market for Europe, I think it remains really, really tight. We might get through this winter if it's a mild winter or moderate winter, not severely cold. But as we get into next year, storage will have been withdrawn and we need to rebuild up storage, but we won't have those gas flows from the Nord Stream pipeline. So Europe will face a bigger problem in some ways in 2023.
Sharon, wonderful. It's been too long. Sharon Bow there of Goldman Sachs on Europe and beyond. Equities right now down about 1% on the S&P, on the Nasdaq down by 1.5. We talked about energy there. Coming up, OPEC ministers recommending the biggest supply cut since 2020.
They are in full panic mode. Democrats have thought they got a reprieve when oil prices fell. The last thing in the world they want or need is anything that causes prices to start marching upward again.
The White House reaction up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, San Francisco Fed President Mary Daly. That conversation at 10 a.m. Eastern, 3 p.m. in London. This is Bloomberg.
They are in full panic mode. Democrats have thought they got a reprieve when oil prices fell. They're facing very difficult elections in November. That oil price drop has been a blessing. The last thing in the world they want or need is anything that causes prices to start marching upward again.
OPEC Plus closing in on a deal to cut output by 2 million barrels a day, drawing pushback from Washington as Democrats look to tame pump prices going into the midterms. Bloomberg's Gillian Lee now in London alongside Anne-Marie down in D.C. for more. Let's get to you, Julian. Just what on earth is happening in Vienna?
I think what it is producers don't like the way the oil market is looking and the way that it's moving. They were very concerned by oil prices below $80 a barrel. They want something that's much closer to $100, and they're acting to get it. The one thing that I would point out is that this 2 million barrel a day headline cut is in their target. It's a cut in the target. The actual reduction in production that will probably lead to is much closer to 880, 900,000 barrels a day, because so many of them are well short of their target levels anyway.
Anne-Marie, do you think that brings any comfort to the White House?
Well, that's exactly what does bring comfort to the White House, Jonathan, the fact that this isn't 2 million barrels a day coming off the physical market, which means there could be a spike in the price, but potentially then it'll settle down, which is why I'd say the White House is not so much in panic mode, but they're probably a bit annoyed at the fact that the optics of this and the timing is not ideal at all. So when you look at the timing of this, in 5 weeks from now, Jonathan, you're going to be sitting next to me here in Washington, D.C. We're going to be talking about the midterm elections and potentially what many would call referendum on the presidency. This does not bode well for the White House 5 weeks out from the midterm elections. And on top of that, the optics of this are also discouraging for the administration with the fact that you have a newly sanctioned Russian official. He is the head of OPEC plus diplomacy out of Russia, the deputy prime minister, Alexander Novak, physically in Vienna. He'll be sitting side by side with Prince Abdulaziz, which arguably the Saudis are the United States' strongest ally in the Gulf. So the timing and the optics of it is what is very discouraging for this White House, not so much that potentially this might not move the market.
Julian, options. One option on the table, and it's been talked about in the press for a long time, several reports over the last several months on this, and the Energy Secretary has not exactly batted them away. Exploring maybe restricting, constraining the ability for US companies to export crude product. Julian, what do you make of that?
I think it's a terribly bad idea, not just for the US. I mean, it's a bad idea globally. I think it will create real problems in Europe, and I don't think it will solve any of the problems that the US administration is trying to solve. I mean, you know, look at crude oil prices when there was a ban on crude oil exports. West Texas Intermediate followed Brent, not in lockstep, but very, very closely. There was no real difference between crude oil prices in the US and crude oil prices elsewhere, and I think you'll see exactly the same with refined products. But what this will do is it will disrupt the flow of the market, and that has to be bad for prices and for security of supply.
The good news is that gasoline prices, on average, aren't at $5 anymore. In America, they're closer to $3.80. But over the last few weeks, Anne-Marie, they're starting to break high, just a little bit. When you think about the options available to the administration, can they lean on the SPR a little bit more? What are the options available?
Well, Jonathan, just quickly, not only are prices on average across the U.S. are starting to break a little bit higher, but if you look at pockets of the country, Oregon, California, you have much higher prices, like $5 a gallon in some places in California, which is why you see Representative Ro Khanna really go after Saudi Arabia on Twitter recently. So what the U.S. potentially has is JP Morgan analysts say they can use the SPR. Halima Croft, in her postcard from Vienna last night, talked about the fact that Ron Klain seemingly said that they can use the SPR to offset the OPEC production cuts. But she's not expecting a big blockbuster use of the SPR, but potentially this could be one of the tools in the toolbox, as what Julian is saying, that the Department of Energy is also looking into potentially what it would mean if they were to have these export controls on gasoline and refined products.
Unreal. Operation Midterms in full flow, it seems. AMH down in D.C. Julian Lee, to the both of you, thank you. Crude bouncing from a little bit earlier this morning off the back of these headlines. More headlines for you. Here's Abby for more. Hey, Abby.
Hey, John. Well, yes, we do have the U.S. Services PMI and Composite PMI, the final reading for the month of September. Both came in a little bit better than expected at 49.3 and 49.5. That's still below contraction. What makes this so interesting, the manufacturing, of course, came in at 52, and we have not had those ISM numbers come in below 50 at all. Still an expansion that has to do with those are bigger companies, John.
Abby, thank you. Up next on this programme, your trading diary, live from New York, with equities trying to recover. This is Bloomberg. If I say bond yields are up, you can probably guess the stocks are down. We're down 0.9% on the S&P 500. Outperformance from the energy names. Energy stocks on the S&P up around 12 percentage points over the last 3 days because crude is up by more than 8% over the same time period. We'll talk about OPEC Plus through the day on TV and radio. That's the price action. Here's your trading diary. Coming up at the top of the hour, ISM Services, plus Mike McKee speaking with the Fed's Mary Daly. Looking forward to that. President Biden speaking at 3:15 Eastern Time. Then you'll get some more Fed speak, Kashkari and Bostic. Later again this afternoon. Evans and Mester on deck for Thursday. Another round of initial jobless claims. And then finally, the payrolls report to close out Friday and get you to the weekend. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.